The Russian President Vladimir Putin is reportedly open to discussing a Ukraine ceasefire with President-elect Donald Trump. Ukraine's EU ambassador telling Bloomberg that the report shows the United States was right to send Kyiv long-range missiles. European stocks and US futures rising. Traders looking ahead to Nvidia results a little later on today for the latest gauge on how the AI boom is going. Plus, high energy prices amongst one factor pushing UK inflation above the 2% target. The Bank of England appears to be heading for a cautious approach on interest rates. Lots going on this morning, lots to factor in when it comes to what is going on with the markets. Let's factor it into what is happening with the stock market story here. We are waiting for Nvidia a little bit later on. This is the picture across Europe in terms of the map. London's underperforming a little bit, but that underperformance was greater earlier on, and actually there's been a degree of catch-up. So broadly green across the screen, but we are fundamentally waiting for Nvidia to figure out what is happening here. You're getting the ECB's financial stability report dropping onto your Bloomberg terminals right now. Economic growth still fragile, trade adding to uncertainty. I think we probably knew all that. Rising concerns about sovereign debt sustainability is another factor that is flagged as well. Debt to GDP ratios, they're a little high here in Europe, particularly considering that we may be having to spend a little bit more money on defence spending going forward from here. Cross asset, we look a little bit like this. Just run you through the numbers and figure out what is going on. You are looking at a story that shows S&P futures a little bit higher, but not by much. We saw a decent rally yesterday afternoon. We're on offer when it comes to the US 10-year. Sterling is a little softer as well, which is interesting considering we've had stronger inflation data out of the UK. We'll come back to that. Copper is up by 0.3%. We've got lots to talk about. Let's get right into it and start the show.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
This morning it's me. Good morning. Welcome. You're watching The Pulse. I'm Guy Johnson in London. There's a lot going on. You've got the Nvidia story coming a little bit later on. But first, let's kick things off and talk a little bit about what is happening with the geopolitical story. So Russia's President Vladimir Putin reportedly open to a ceasefire deal, or at least ceasefire talks, in a discussion that could certainly involve the US President-elect Donald Trump. The news comes this morning after Ukraine took advantage of its newly granted long-range missile capabilities, striking a military base in Russia. Ukraine's ambassador to the EU telling Bloomberg exclusively that this news is a sign of Ukrainian strength.
You see that as soon as Ukraine is getting stronger, as soon as Ukraine could be capable to strike back, you see what's happening in Russia. So you see this development, and also what happened with this Putin's decision about changing the nuclear doctrine. It shows that it works. So if you talk to him with a position from strength, so they're more ready for a conversation.
Let's bring in Bloomberg's Ollie Crook on this subject. Ollie, it sounds awfully like negotiations have already started.
Yeah, Guy, listen, this is a sort of consequential report from Reuters out this morning, if it is in fact accurate. They're citing a number of Russian officials and former officials, but basically this boils down to the idea that Putin is open to beginning to have talks about a ceasefire deal with Donald Trump, the president-elect of the United States. The reason that this is significant is while we've heard sort of broad ideas about what Russia wants and what Ukraine wants, we have not had very sort of specific drilling down into what the Russian position is on negotiations, and we got some of that from this report. So the first is that there may be room for negotiation over the carve-up of the Donetsk, Luhansk, Zaporizhia, and Kherson regions. That is the first time we're hearing about that from the Russians. They may also be open, we understand from this reporting, to withdrawing some troops from other parts of Ukraine, right? These are sort of the outlines of a potential beginning discussion point. There's also, of course, the opposition to Ukraine ever joining NATO. This has been a sort of bone to pick from the very beginning of this invasion of Ukraine for Vladimir Putin. Also, the fact that the sort of Biden has provided these missiles, some of these officials are saying, may make the negotiations a little tougher. We should make a number of caveats here, Guy. For the first sort of point is that this is sort of very far away from actual talks, from actual negotiations. That being said, with the Trump presidency, any timeline that we may think we have on what these talks could be, or their sort of course or their pace, may be completely, blown up. There's going to be high objection from the Ukrainians on this. This is a non-starter on many, many points. But again, significant if this is true, because this begins to stake out the outlines of the Russian positions, the negotiating positions for a possible ceasefire and potentially, ultimately, an end to the war.
We're getting some lines coming out of Interfax right now. Russia doesn't want to freeze the conflict in Ukraine. It's certainly one of the lines that stands out. But we are talking about, and the Reuters report flagging this idea that potentially the various permutations of how land could ultimately be distributed could be on the table, which I think is really interesting. The fact that they don't want to talk about it suggests that maybe it is a significant part of the conversation. The last 24 hours, though, has been almost a prelude, it feels like, to discussions. It is normal for Russia to escalate a situation before it goes into talks. This feels like it's a playbook that we've seen before from Putin. But the last 24 hours have been hugely consequential nevertheless.
Yeah, Guy, I mean, listen, it's been sort of escalation, de-escalation, re-escalation over the last sort of 24 hours. So just disentangle some of the news we got that sort of culminates with this Reuters report that we have out this morning. I mean, it began with Biden sort of allowing the Ukrainians to strike within Ukraine. Those strikes followed in short order, but they didn't strike just in the Kursk region, which was sort of what we understood to be what were the permissions was. This was a strike that Ukraine had a little bit further within Russia. And the reason that the market got so distressed by it, and we saw a massive sell-off yesterday, albeit somewhat briefly, had to do with the fact that these were strikes that were, A, further into Russia than had been anticipated, but also the fact that this is not something that Putin also at the same time signed a sort of renewed nuclear pact, a sort of new sort of approach to how they sort of look at their nuclear deterrence. And I'll quote directly here, Russia saying that any attack on its territory by a non-nuclear state, i.e. Ukraine, that is supported by a nuclear power, i.e. the United States, they will consider that as a joint assault to which an appropriate reply could possibly be a nuclear retaliation. Again, all of this news sort of came very thick and fast yesterday. You saw it represented over into the markets. And as we sort of grope in the dark of war for where the red lines were, there was real concern that this might be one of them. That being said, now we're getting these sort of reports out of Reuters. So maybe there is some motion potentially moving towards a negotiation. But again, it is very hard to say with any kind of certainty.
Ollie, great stuff. Thank you very much indeed. Ollie Crook joining us out of Berlin. What's been really interesting is to track the arc of the Euro-Swissy pair over the last 24, 48 hours. You see, obviously, the markets, which are very much trading on headlines at the moment, see a significant move into safe havens. The Swissy, that has almost completely reversed now. The market already looking through the geopolitical tension that we are seeing, maybe that Ollie has been flagging. So you've got all of this geopolitical tension. You've got uncertainty over the policies of President-elect Donald Trump. But you've also got Nvidia coming out a little bit later on. Our next guest is overweight risk assets. Thushka Maharaj, global strategist, multi-asset solutions at JP Morgan Asset Management, joining us to discuss. Good morning. So you've got geopolitical tensions.
Good morning.
You've got uncertainty around the Trump presidency, but then you've got Nvidia numbers out a little bit later on. In terms of how you're thinking about the various risks around the various things that are happening right now, does Nvidia stand out as the major risk in terms of wanting to be risk on right now?
Good morning, Guy. Thanks for having me on. I would agree with the point about uncertainty. I think we are dealing with a heightened level of uncertainty at this point, but it doesn't not imply that we are uncomfortable taking on risk. To your point, we are overweight risk assets, mostly based on a fundamental outlook where we see a strong underlying consumer in the US, where we see the prospects for more support coming from the new administration. But also, we've had rolling recessions up to now, and we are now starting to see parts of the economy that were hit by higher rates starting to recover. And so we are overweight risk assets, prudently overweight risk assets concentrated in the US, but that's predominantly driven by our fundamental outlook. Do we see risks around Nvidia? Yes, we do. We are broadening out our equity exposure to diversify our equity holdings outside of growth. But I'd point to two things. One, the earnings season thus far, we've seen actually the Mag 7 stocks delivering over 30% in terms of earnings up to now. We'll see what Nvidia, what we hear overnight. But the idea that they are still outperforming expectations is giving us more confidence in our view. But next year, when we look to 2025, so that's the second point, we are seeing this earnings estimates broadening out. So for next year, the Mag 7 delivering around 22%, whereas the rest of the S&P increasing their earnings to around 10 to 11% from about 5% today. So a doubling, an acceleration in the rest of the market is what gives us confidence in that broadening out theme in the S&P.
Okay, let's the broadening out is a theme that I'm hearing a great deal right now. The market, the expectation is therefore that the US rally continues to roll on, even if we do see this rotation coming through and the market broadening out. Valuations are, though, stretched, but are valuations the only fly in the ointment right now? If you look at Capes, if you look at Shillers, if you look at all kinds of valuation metrics, they're very, very stretched. But there doesn't appear to be a catalyst in order to get people to sell out of this market.
Well, I'd say your point about uncertainty at the start is it is a concern over the medium term, but it's not enough to force us to be de-risking portfolios. So our valuation's too expensive to be invested. We would argue that once you adjust forward PE ratios for future growth, so the PEG ratio, that's more in line with long-term averages. It's slightly elevated, but not as elevated as if you just optically looked at a long time series of PE ratios. So that's one factor. The other is the integration of AI into more from the production of tools into the usage of those tools provides an upside risk even to current valuations. So the idea that the market can grow into those valuations is, I think, is what's supporting the market.
If we get to a 5% US 10-year, is it logical for me to want to buy equities, or should I be buying bonds at that point? At 5%, is the equity risk premium kind of, does that suggest that we should see a shift?
So when we think about our long-term outlook for both fixed income and equities, yields above 4.5% in the US 10-year offer significant value to us. We have an equilibrium forecast for the US 10-year around 4%. And so the total return, or the expected return over that 10-year time frame, if we were to get to 5%, would be attractive. So I would argue, depending on what conditions took us to 5%, without knowing those, that underlying view, at 5% or even closer to 4.7, 4.75, yields start looking, bonds start looking attractive. What I would say, though, is that it's been interesting post the election. The market's been unable to break above 4.5%, and we take that as a very positive sign for duration. It still remains very volatile, but the idea that post the prospect of a red sweep, we still are struggling to break above 4.5% is crucial. And then the final point is, obviously, it does matter what's the catalyst that takes you higher in yield, right? So it's not like close your eyes and buy moment. We need to understand the conditions, but they start becoming, from a long-term investment strategic perspective, bonds start looking more attractive.
Yep, as you say, you got to know why. Thushka, thanks very much indeed for joining us. Thushka Maharaj from JP Morgan Asset Management. Great to see you. Thanks very much. What are we going to do next? We're going to continue the conversation. We're going to talk about this escalating conflict between Russia and Ukraine. Where does Trump fit into this? Are we going to see negotiations? Are we warming up for that? Has the use of these long-range missiles changed the equation? We'll discuss all of that next. This is Bloomberg. 16 minutes past the hour. Welcome back. So within the last couple of minutes, the Kremlin has claimed that it doesn't want to freeze the conflict in Ukraine. There's been some suggestion that's ultimately where we are heading for. Let's discuss this a little bit more. Livia, Paggi, Managing Director, Global Investigations at JS Held, joining me around the table. Nice to see you.
Nice to see you.
What do you make of events of the last 24 hours? Is it an escalation of what we're seeing, or is it a prelude to talks?
We've seen really an escalation taking place over the past few months. We've seen that with Ukraine making incursion into Kursk and also with Russia deploying troops from North Korea. So actually, this is really a kind of build-up to what could be negotiations taking place when Trump arrives as president in January.
Trump said he'd have it sorted really quickly. Is that going to happen?
I mean, as we know, Trump, there's a lot of bluster, a lot of words, but certainly if you look at the different policy priorities of Trump, it's, tax, immigration, Middle East.
Yep.
Ukraine is not really top of the list. Certainly if he can make a deal and it's easy, he'll go ahead and do it. If there's complications, I don't see it happening immediately, and certainly I don't think it's where all of the initial energy is going to be on.
So there's this growing expectation that this is a conflict that ends in 2025. Are we over our skis in that thinking?
Absolutely. I think it's really unclear yet what's going to happen. We have to keep in mind that Putin's demands are extremely ambitious. It's not only territorial issues, but really security issues is the main priority for Putin, and that is an unarmed Ukraine that doesn't join NATO, and that is going to be very difficult for the Ukrainians to accept.
What does this mean for Europe?
Europe is really stuck in the middle, right? I mean, Europe is much more exposed to the conflict than the U.S. We've seen that there's been a drift between U.S. and German positions. The U.S. has been willing to give out ATACMS and missiles to Ukraine, whereas Scholz has been much more hesitant and says that this is not something that we can do and escalate the conflict on our border.
So is that something that, if you were to see a change in German government, would that be something that you would expect to continue? If the conflict continues, is that something that we should expect to continue? If the conflict has a greater duration, is Europe going to find it harder and harder to resist sending bigger and bigger weapons into the conflict zone?
I mean, Europe's very much divided. We've seen France and the UK. They've been hesitant on whether to support Ukraine. Whereas inside Italy, for instance, there's much more division on whether to support Ukraine or not. I think how united Europe will be on it is a big question. Certainly, they are trying to protect Ukraine and also de-escalate the conflict. That is Europe's priority at the moment.
But in terms of Europe's defence spending priorities, does this imply more money needs to be spent on defence?
Absolutely.
If you think about the way that the budgets are going to work.
Absolutely. This is certainly a priority where they're going to have to be thinking about how are we going to contain this conflict.
And what do you think the answer that they will ultimately come up with is?
I mean, I think what we see is, certainly we're going to have to hold out until the elections take place.
Yeah.
Then afterwards, I think there probably will be more support and more spending for Ukraine.
How significant a shift has the arrival of North Korean troops in Russia been? How significant a shift does that portend in terms of the way that this conflict is likely to develop?
I think what the North Korean troops signifies is what this war is about, that this is ultimately a proxy war between...
So we're back to Cold War, classic
Exactly. So in many ways, it's not... I mean, it was quite surprising to see him be able to draw on North Korean troops. But what he's saying is that Putin is saying Ukraine is getting weapons from the West. I'm going to draw on my allies and bring them in to support me. And we've seen support from China for Russian arms. We've seen support from Iran. So really, it is exactly old classic allies coming in, being brought into this conflict.
So what do the classic proxy wars of the 70s and 80s teach us, therefore, about how this ends?
What it teaches us is that this is not going to be resolved probably in the first 6 months of 2025. And that really, actually, what we are likely to see is that it could be protracted for quite a bit longer.
Like the history from that period would suggest that it's a very messy solution that ultimately gets dealt with.
Yeah.
If you think about what happened with North Korea, if you think about the Korean War, if you think about into Vietnam, all of those sort of conflicts, Afghanistan, all of these conflicts result in a very messy endgame.
Exactly.
Is that where we're going?
I think it is in many ways. We've seen this conflict protract. It's been going on actually since 2014, right? That's when it really started, and we're here in 2024. So I think that is, it's going to be drawn out, and that's what Putin has prepared himself for. We've seen him drumming up a war economy, and he's ready to keep going.
Livia, thanks very much indeed for stopping by to see us. Livia Paggi, the Managing Director of Global Investigations at JS Health. Thank you very much indeed. Plenty more still to come. We need to discuss what, of course, is the main event of the day, and that is a video. We'll do that very shortly. This is Bloomberg. 24 minutes past the hour, let's call it 25 minutes past the hour. You're looking at live pictures coming from Wolfsburg in Germany. The Labour Council is giving a press conference. This, as we see Volkswagen potentially talking about closing plants in Germany. That has been verboten. That's been forbidden in the past. But what we are seeing now is the idea that maybe the Labour Council is suggesting that you could see a restructuring without those plant closures. They're talking about maybe giving up some of the bonuses. They're talking about other ways of doing this. We are Volkswagen. We stand together, seems to be the message coming through, and we can avoid these closures. Volkswagen's share price moving a little bit to the downside, but not a great deal. What are we going to talk about next? We are going to talk about the gas crunch that is hitting Europe. It's pretty cold outside right now. You're seeing maybe a dip into some of the storage that we have here in Europe. We are going to talk about what happens next with the gas story here in Europe with the CFO, of Equinor. That conversation next. This is Bloomberg. Half past the hour, let's call it half past the hour. Good morning, you're watching The Pulse. I'm Guy Johnson in London. Let's run through your top stories of the morning. The Russian President Vladimir Putin is reportedly open to discussing Ukraine's ceasefire with President-elect Donald Trump. Ukraine's EU ambassador telling Bloomberg the report shows the US was right to send Kyiv long-range missiles. European stocks and US futures ticking a little bit higher. Traders, of course, looking ahead to the Nvidia results which come out after the bell. We're trying to judge what is happening with the AI boom. Nvidia had a really strong session yesterday. Plus, high energy prices, plus pushing UK inflation above the 2% target, keeping the Bank of England on course. Very cautious approach, a gradual approach, I think is the right language when it comes to interest rate cuts coming through next year. Part of the mix in the inflation story was very much what was happening with that energy story. We've highlighted that. There are other factors in the mix as well. What's happening with education, what's happening as well with property prices. But energy prices rising is a story that we're seeing across Europe. And it's cold outside. And that means, once again, gas prices have been pushing a little bit higher. We're retreating maybe off some of the highest levels of the year. We're watching what the geopolitical story is looking like. That's going to be a factor as well. Rachel Morrison, our team leader for gas, power and renewables in Europe, joining us around the table. What's moving prices right now? Is it because it's cold outside? Is it the geopolitics? Is it just the mechanics of delivering gas around Europe? What's going on?
There's so many things contributing at the moment. One of the biggest things that we're watching is what's going to happen to the transit gas deal that ends at the end of the year.
This is transiting Ukraine?
This is gas that transits Ukraine, Russian gas that transits Ukraine and comes to Europe. So when that deal ends, we're trying to figure out, as is the rest of the market, what's going to happen to flows. And that's a big driver. And obviously all the geopolitical events, the things that you mentioned in the intro, what's happening with a potential ceasefire, all impact what could happen to those flows. And then, of course, LNG, Europe is looking to make sure that if anything does happen to the flows and we don't see any gas from January the 1st, that LNG will still arrive and that we'll still have enough gas, and looking at storage for next year too. So all these factors are what are sort of keeping prices elevated at the moment.
Is the price telling me that there is a concern around there being enough gas? What is happening with storage? Do we have enough there? We're dipping into it already. What does the outlook look like if we extrapolate forward?
Yeah, that's been really interesting to see that already at this time of year, we're using gas up from storage quicker than we usually do. So what that kind of means, not that we're not going to have enough gas this winter, but that gas storage levels could get really low. So the task to refill next summer is greater. And we're seeing that show up in prices. So summer prices are really high. And that's incentivizing people to not put gas in storage. So the next big question that we're asking is, will governments step in to fill those storage sites? What will happen with prices this high for the summer?
Interesting. Still, we're not the kind of super high prices we were at, but it's interesting to see them creeping higher, significantly higher. Rachel Morrison, our team leader for gas, power and renewables in Europe, joining us around the table. Also here is Torgrim, Reitan, CFO of the Norwegian energy firm Equinor, Europe's biggest natural gas supplier, as if by magic. Nice to see you.
Good morning and good to see you guys.
What do you make of the gas prices that we're seeing at the moment?
Well, first of all, I mean, we are currently seeing, a rather tight market coming into the winter. And we see that, gas is drawing from storages more than expected already. And that is driven that sort of there is an increased competition for LNG cargoes for the time being.
Yep.
So you know, the European market has become an LNG price market, and that is really what we are facing. So there's a competition between Asia and Europe as such. But I think it's very important for me to say that sort of as an energy provider to Europe, it is extremely important for us that we are a reliable producer, and we sort of see to that we are in the market with our gas, fully committed to supply Europe in a potential cold winter.
Rachel raised the question, what do you think happens when the transit deal ends across Ukraine?
Yeah, it is clearly a big question. There is, 14 BCM coming through Ukraine, which is in a way limited in a total market of, say, 370 BCM. But it illustrates how fragile it is, because 14 BCM is not that much in the big scheme of things, but in a fragile market, it can really drive prices both ways. So we are clearly monitoring that situation very, very closely, but ultimately it will be sort of have to be compensated by LNG imports. We will produce at maximum during winter, so it will need to come from LNG and competition for an LNG.
But that's a global market.
That is a global market.
And that means that Europe competes with China, it competes with all kinds of other areas within the world.
And you actually see today that sort of the price difference between Asia and European market is very tiny for the time being. It used to be higher because a longer way to transport it to Asia than to Europe. So clearly Europe is buying LNG for the time being. So very important to monitor demand in Asia and China in particular, because that will set the price for the European gas market.
Can we rely on the United States?
The United States is a very, very important player in the energy market, and export of LNG from the US is coming, and we do believe, with the Trump administration, that sort of the moratorium on new LNG developments will be lifted. So over time, we do think there will be more LNG coming out of the US.
How quickly do new trains come on, do you think?
Well, those are massive investments and a lot of complexities around it, but they will come. We recently made an acquisition in the US into even more exposure to gas in the US, because we do believe that gas prices will be healthy in the longer term, and we do believe that gas out of the US also will be priced at a higher level than it has been over the past. So we are a true believer that sort of US gas is going to be an important part of a global gas market going forward.
You've also invested in the United States heavily on the renewable side.
Yeah.
How does the Trump administration treat those renewables that you're investing in?
So, we have a very broad approach to energy in the US. We have significant production out of the Gulf of Mexico. We have onshore gas production, and then we have wind development out of US. That is the Empire Wind project.
Yep.
It is probably the most mature offshore wind project in the US. We have all the federal permits, and we are moving forward with that development. We do believe that sort of offshore wind has a natural place and an important place in a US energy mix.
But is it downgraded in the energy mix? Is it less important in the energy mix in the United States with the Trump administration?
Well, that remains to be seen. I mean, we work, very well with both, Republican administrations and Democratic administrations, and clearly we will work closely with them also on this front. We do believe that wind in the US will have to be an important part of it, particularly related to the development of data centers and AI capacities that is planned for in the Northeast, and clearly a big push for renewable supply into that. It has to come either from these type of sources or natural gas sources. We are placed in both.
Investors are watching what you're doing carefully, and they're wondering what happens beyond 2025, into 26, 27. Looking at your investments, are you favouring capex over return to shareholders? Is that the way that we should think about Equinor going forwards as you build out this base that you're particularly developing in the United States? Is it favour one and not the other?
Well, thanks, Guy. It's a very important question.
Yeah.
So just let me give you a little bit of context. This year, we are returning around 19% of the value of the company to our shareholders through share buyback and cash dividend. Last year, around 18 to 19%. So over the last 2 years, we have returned 35 to 40% of the value of the company to our shareholders.
The market's a discounting mechanism. It's looking forward.
Oh, yes. So, but I think it's very important that we, we have to look at what we actually are doing. Going forward, clearly we will continue with a competitive capital distribution. This is very, very important to us, and we will prioritize that. We come into this with a very solid balance sheet. We have negative debt for the time being. We come into this with a very flexible investment program, and we also come into this with a very resilient portfolio for a low price environment. So what investors should expect from us is that we remain consistent with our capital distribution through the cycles and are remaining competitive. It has a high priority.
So we should expect that 19% number to continue?
Well, the 19% is based on a very extraordinary situation in 2022. Right. But we have guiding out there that sort of remains firm. I think it's, when it comes to the whole transition part of our strategy, just a few words on that, because oil and gas, we continue to invest, and all the way to 2035, we will produce on the same level as we produce today. On top of this, we are going to build, a renewable business, but also important that we are disciplined and we find the right speed, and then we create shareholder value on the way. So far, double-digit returns on what we have done. We also will do that going forward. So we will remain disciplined in that sort of growth.
Can I just ask you a sort of broader theoretical question about that energy transition? Europe needs to do two things right now. Well, it's got lots of things to do, but two of the big things it has to do is deliver an energy transition and rearm itself. Mm-hmm. Do you think you can do both?
I do think it is possible to do that. Clearly, we see that energy security is becoming a more and more important part of the energy dialogue in Europe. So we see ourselves as a company in the midst of all of this. Now, of course, with our natural gas, also with our oil coming to Europe, and then building renewable activity that sort of also helps on energy security. And maybe the last point is around carbon capture and storage that we do think will have to be very important. And clearly we see Norway as sort of a main player in building storage capacity for the industrial Europe on this.
Final quick question. You talk about the combination of energy and security. We've just seen a couple of cables cut in your region. And one of the things that I hear, certainly from military and geopolitical specialists, is the concern around Norwegian fields and their security. Mm. Is that something that we need to pay greater attention to?
Well, the whole world is paying a lot of attention to that. And you would understand that the Norwegian infrastructure with oil and gas installations and pipelines and all of that has a lot of attention from a security perspective. So this is very well overseen and managed, and it is clearly high on the agenda for everyone, both on the producing side, but also on the demand side as such. So we have a lot of attention to it and monitoring and
very
carefully and collaboration with all relevant states and institutions.
Torgrim, great to see you. Thanks for stopping by.
Thank you very much.
Here at Bloomberg this morning. I know you've got another meeting still to go to. Torgrim Reitan, the CFO of Equinor. Thank you very much indeed. Coming up, UK inflation coming in a little hotter than anticipated this morning. We're going to discuss what that means next for the Bank of England as it weighs what to do next. How gradual will the rate cuts be? We'll find out next. This is Bloomberg.
India's growth of energy demand is such that we cannot in the short term meet all of that through renewable energy, irrespective of how hard we are pushing growth right now. So some part of the balance will have to be met by coal for the near term. But I think by 2035 or so, I think we'll reach a level of renewables addition where we won't actually need coal and we can then start replacing coal. So by 2045, by 2050, coal would have gone down substantially and renewables will form the large part of the grid. and maybe nuclear and hydro and so on. So I think give us a little bit of time and we'll get to a point where our energy system will be fundamentally driven by clean energy. And that will also, by the way, have a massive benefit for India because it will decrease our dependence on imports of fossil fuels. Today, India pays almost $200 billion every year for importing fossil fuels, which is a big Achilles heel of India's economy. Now, all of that will get addressed. And I think the government recognizes that, and Prime Minister Modi has been pushing forward the whole issue of energy independence through renewables very substantially.
Huge shift in terms of trade. Like India's investing massively at the moment in solar. The new CEO speaking to Bloomberg, one of India's largest renewable powers developers, talking about how the country migrates away from fossil fuels. It's going to take a while, though, seems to be the sense maybe that he was giving. You can see the full interview. You're going to want to watch that. Lacqua Goes Green. It's going to air at 9:30 p.m. New York time tonight, 6:30 p.m. London time Thursday. Talking of the UK, let's talk a little bit about what we saw this morning in terms of the inflation data. The pound pairing earlier gains. This after UK CPI accelerated, the data dropping at 7 a.m. this morning. That was data for October. Annual inflation now above 2% target. We've seen a jump in energy bills. You've also seen a jump in other factors as well. Housing is an area that we've seen a significant jump in. Travel's been an area that you've seen a significant jump in. Education's been an area you've seen a significant jump in as well. Dan Hansen, Chief UK Economist at Bloomberg Economics, joining me around the table. How shall I read these numbers?
A little bit worrying, but probably not quite as worrying as you've just painted there.
Yep.
Just to go against you slightly. I think if you take out things like education, things like accommodation, things like airfares, if you think about how the Bank of England thinks about this stuff, it looks through all that. So if you sort of go beneath the surface and look at services inflation, there was a bit of a downtick. It was sticky on the headline. You know, it moved up.
Okay.
But I think if you look beneath the surface, I think there is a little bit more positivity in there than the picture you
OK, 5% is where the Bank of England thinks it should roughly be, and that's kind of where we were. In terms of its forecast, we're kind of pretty much in line with where the bank thought we would be. However, I see your kind of strip out the bits that are rising and the rest of it looks all right. And I raise you the impacts of the national insurance contributions, which we've still yet to factor in. And the hospitality sector is screaming at the moment that it is basically going to be a pass-through story, and we are going to see this showing up in inflation. So you could argue, yes, I can strip out the education stuff and the travel and all that kind of stuff, but nevertheless, this could be the calm before the storm.
Yeah, and here I fold.
Yeah, OK. Fair enough.
So you're absolutely right. I think bigger picture, if you're looking at headline CPI, we had this sort of good news over the summer, right? We had this move below 2% in the September figure. I think looking forward, look out 12 months, it's very hard to see inflation not being in and around the 2.5% mark across that window for all the reasons you've just described. So you have one-off factors like, you know, private school fees and the like that'll hit the numbers in January.
This is, at the moment, what we're seeing is education being driven by university fees.
Exactly.
You haven't seen that pass through from the VAT story.
Exactly. I mean, there may have been some schools that passed it on, but yes, it's coming through in January. And then, of course, the big story is NICs come April. And, you know, there are two sides to the NICs story. One is that firms adjust through employment. And, of course, that would be very disinflationary. It wouldn't be inflationary. But at least the way the OBR's been looking at it, the way the bank's been looking at it, is that it's some combination of adjustment through, in the near term, lower margins and higher prices. But, of course, if you take a lower margin in the near term, you're going to want to rebuild that in the future. So there is a sort of, that might not be inflationary now, but medium term, it is still inflationary. And so that's obviously what the bank is going to be worried about.
So what does gradual mean? You guys have got penciled in quarterly cuts next year. Is that still the baseline?
It is still the baseline. I mean, I think, and the market's moved, obviously it moved after the budget quite dramatically with next year, I think, you know, ending the year around 4%, so maybe only two to three cuts next year. I think that's beginning to look like the bigger risk. You know, everyone was talking probably end of summer, early autumn about things becoming, to use Andrew Bailey's term, a little bit more aggressive.
Yeah.
It feels to me that the risk now...
In terms of his ability to cut?
Yes, exactly, to move rates lower more swiftly and on a sequential basis. I think the risk now is that they get stopped out next year at some point because inflation just looks like it's the disinflationary process just stops and things don't continue to move in the right direction. And that brings into a broader question about which we've discussed before around neutral rates. Does it have a 3 handle or does it actually have a 4 handle? And I think that will be the big question for the next year with monetary policy.
And if it's got a 4 handle, gilts at 4.5, maybe look a little bit mispriced. We'll see what happens around that. Dan, great to see you. Thanks very much indeed. A little game of poker with Dan Hansen of Bloomberg Economics. Coming up, the world's most valuable chip company reporting earnings later today. It is, of course, a barometer of global demand for AI. We're going to look at what we should expect from NVIDIA. That conversation next. This is Bloomberg. Morning, Wednesday morning, NVIDIA day. Little interesting fact for you. The combined market cap of the CAC 40 and the DAX is 4.2 trillion. The market cap of NVIDIA is 3.6 trillion. Basically, NVIDIA is almost worth what the combined value of the CAC and the DAX is. Kind of gives you an idea of the importance of what is about to happen. We're going to get NVIDIA numbers after the bell. Markets on tenterhooks. What are we going to get? Tamlin Basin, technology analyst at Bloomberg Intelligence, around the table to discuss. What am I looking for?
Well, I think we're looking for a few things. We're looking at the overall themes that management is going to discuss. And I think here investors are really going to be looking at where are we in this AI hype cycle? Where are we that would really drive that valuation that you were just talking about that has really boosted NVIDIA's valuation? Are we seeing a transition from the AI training to AI inference? Yep. And if so, what is demand going to look like there? And also, where are the pockets of demand? Is this still mainly hyperscalers, cloud service providers? Are we seeing more other enterprises starting to leverage AI to build out their own systems?
How hot is Blackwell?
Well, that's sort of the key question, and I would certainly expect a lot of questions on that. There have been news reports that it overheats. This is sort of a known thing. You have 2 cooling mechanisms for Blackwell. You have air cooling and this new liquid cooling. So I think a lot of investors are going to be interested in, are clients going to leverage the liquid cooling? Yep. Is there a little bit of intimidation of this going forward? So
it's hot from a temperature point of view. Is it hot from a demand point of view?
So far, the indications are it's very hot from a demand point of view. So NVIDIA is expected, they've indicated that they've worked through the supply issues in 3Q. They are already expecting a few $1 billion in revenue in 4Q, which is the next quarter. And they do think over the near term that demand is going to outstrip supply. So I think there's still a lot of demand for Blackwell.
I've got the popcorn ready. We're going to wait and see.
Absolutely.
It's always a great day. Tamlin Basin, technology analyst at Bloomberg Intelligence, joining us ahead of the NVIDIA numbers. Up next, it is The Brief. Danny Berger, Manus Cranny in New York. It's NVIDIA day. Of course they're going to be talking about this. Basically, the whole day is likely to be dominated by the build-up to the NVIDIA numbers that are going to come after the bell a little bit later on. We'll be digesting those numbers in Europe tomorrow morning. We'll be looking at the read across into some of the key European stocks. But that is going to set the session today, tomorrow, and possibly the next day. We'll find out very shortly what actually NVIDIA can deliver. Anyway, that's the picture of New York. I'm going to hand things over to Manus and Danny. This is Bloomberg.